You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market, from unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tussaw from RCM Asset Management, Andrew the Rock Lobster Joe Vanazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. The Option Block is brought to you by Options House, a powerful, easy-to-use, and intuitive online trading platform that's not only fast and reliable, but comes with dedicated customer service and a great trading experience. Trade on the platform that's top-rated by Barron's and Stockbrokers.com. With completely transparent, value-oriented pricing, Options House is your all-in-one solution for options, futures, and stock trading. Plus, open and fund a new account at optionshouse.com/insider today and trade commission-free for 60 days. Options House is a member of FINRA, SIPC, and NFA. And now, get ready to hit the option block.
All right, everybody, that rockin' tune means it's time once again for a little show we like to call around here the option block. A little bit of wisdom, a little bit of analysis, a little bit of earnings breakdown today. It's fun to be back in earnings season, as well as some of your questions, some strategery, some peering into the future, a whole bunch of unusual activity, and you have the tasty cocktail that is the option block. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Pleased to be back from my gallivanting last week. Our schedule was a little bit off last week because we were off at Stocktoberfest in San Diego. Got to do a bunch of fun shows out there, which should be hitting the network as we speak, so stay tuned for that throughout the week, listeners. A lot of great content, including some of the panels and speakers from out there as well, so it should be pretty interesting. So stay tuned. If you couldn't make it out to San Diego, then we got you covered. Don't worry. And, of course, we always, as usual, have all the rest of the great content here on the old network, including the option block. And where can you find all that great content? The mothership, theoptionsinsider.com, as well as iTunes or TuneIn or Stitcher, Google Play, all the other fine places you'd like to download your podcast. Whatever obscure podcast app you like, chances are we're there. If we're not, hit us up. Let us know, including via our own app, which is available, of course, across all of the major app stores. And however you listen, including those of you who can join us live every Monday and Thursday, 3 p.m. Central, 4 p.m. Eastern via Mixlr, MIXLR. We'd love to see you guys there as well. However you join us, however you listen to us before or after the fact, make sure you send us your questions, your comments, your insights. We love to hear from you guys. And joining me on the old program, let's go in order of immediate proximity this time. Starting off, staring at me to my left, he's dying to get on the show, chomping at the bit. Mr. Steve Clausen, the Chief Investment Strategist over there at Options House. Steve, welcome back to the Option Block program on this fine Monday, sir.
Thank you so much for having me and having me physically and personally in the studio. It's great to see how all the magic happens.
All the magic, the very hot studio today, because we've been doing a lot of shows already today. And whenever I start talking, Steve, the hot air just fills the room. I don't know how that happens. It's a magical occurrence that happens all the time. And let's go a little bit farther afield now to that mystical, magical paradise known as St. Charles, Illinois, where we are joined, I believe, if the Skype gods are smiling upon him, by Uncle Mike Tussaw from RCM Wealth Advisors. Uncle Mike, welcome back to the program, sir.
Always happy to be here on a beautiful Monday. It is a gorgeous day out today.
It is beautiful. I'm kind of a little bit jaded because I just came back from San Diego, where every day is ridiculously beautiful. But yeah, for Chicago in October, I'll definitely take it. It's nice.
You brought the warm weather back.
I totally did. Speaking of my trip, good job pinch hitting you and the Rock Lobster for me last week, taking the reins on your shoulders, answering a bunch of questions, having a bunch of fun. So hopefully you enjoyed filling in, sitting in on the big chair.
Oh, always enjoy it, but shoes are too big for me to fill. I will yield to King Longo.
Well, I will gladly take those shoes back, even though they are, you're right, pretty crazy. Like clown shoes. I trip over myself all the time. And speaking, let's go a little farther afield once more to welcome in the fourth member of our broadcast team, the Rock Lobster himself, straight from the fairway, straight from the golf course, listeners, where he was driving golf balls. Shows you the kind of life he's living out there, riding in yachts, lobster fishing, driving golf balls, living the life of the 1%er, Mr. Rock Lobster, from Andrew Giovinazzi from OptionPit.com. Good job to you as well last week, pinching in there, sir, and I'm sure you can take your appropriate umbrage now.
I was, but then I was wondering how long it would take us to get some sort of killer clown reference onto the show. You know, all the clowns, like the pretty clown. And we just realized, Tucson brought it up. It just right there, it's you, Longo. You're the one. You're the crazy clown with the shoes.
I'm the killer clown of the program. That's a horrifying analogy because I'm not a big fan of clowns myself. But yes, I guess they're even threatening the hinterlands of Maine. That's how far the clowns have reached.
Yes. There was a sighting.
Oh, jeez. Clowns. The inescapable reach of clowns. Before they listen to us and storm the studio here, we're going to keep on rolling right on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, everybody, welcome to the Trading Block. This is indeed the portion of the program where we break down what was moving, what was shaking, what was lighting things up in today's market activity. As I mentioned, we are streaming this live and indeed recording it on Monday, October 17th, for all of you playing along after the fact. And another interesting day. It is nice, it is refreshing to be back in earnings season. So to be able to talk about some actual concrete developments in the marketplace, things we can measure and compare and contrast very rationally, rather than some of the myriad macro events we've been privy to over the last few months. So it is a nice change of pace. We are indeed in earnings season, and the market at least kicking things off this week, slightly to the downside, off about 1/3 of a percentage point, depending on where you're looking. Pretty much all the major indices off percentage-wise, a fairly similar amount. VIX cash taking the weekend back and a little bit more, about 0.2 of a point or so out there, hovering a wee bit north of the 16 handle, 1630, as we go on into today's show. So we'll see if our aggressive fading of all things Russell's and mine, aggressive fading of all things VIX. So Russell was a little bit less than me. He was actually, I think, bidding to the upside. But myself, I was aggressively fading. We'll see if which of our predictions comes to pass here on the old volatility views program. But a lot to sink our teeth into. We had Bank of America before the bell and Hasbro. We got some names coming out as we're talking, including good old Beamer and good old Netflix. So a lot of things to sink our teeth into. Steve, you haven't been on in a while, so I'll let you kick things off if you are indeed so inclined. What caught your eye in today's activity, sir?
Yeah, actually, today's activity, what caught my mind was nothing was catching my mind, quite frankly. Bank of America, they had a nice move last week when JP Morgan and Citigroup, they both announced positive earnings, relatively positive earnings. Bank of America had a nice move above 16. Today, they came out with earnings. And again, they had, you look at the bottom line number, real good. But the reaction in the marketplace maybe already happened. So last week, I think Bank of America got its move. Today, it didn't get much of a move, and we got that volatility crush that happens after earnings. And the at-the-money 16 strike handle straddle sort of got whacked, and not a lot of expected movement the rest of the week for the financials. Financials, as a group, have been one of the leaders lately, one of the leading sectors in the last couple of weeks, and maybe it's run its course. So we kind of had a nonchalant kind of day. Of course, the earnings coming up this week are going to be a little bit more diverse. A few more sectors are going to be heard from, and so the rest of the week promises to be a little bit more exciting. But Monday was kind of a snoozy Monday to me.
Yeah, you mentioned this on your blog, and Steve, if people want to go check out your blog over there, where should they go to see all your market insights when they're not listening to the show?
Yeah, they can find the Options House blog. Every Monday morning I write a little blog about what traders focused on last week and what was the biggest thing of the prior week, and then take a look at what is going to be in focus for the week to come. And they can find that at optionshouse.com. And at the bottom of that, we have resources. We have educational materials like webinars and archived webinars in there, as well as the Options House blog, where you can find out about all things Options House goings on.
Yeah, and you were breaking down some of the earnings here. You mentioned Bank of America on your blog, and we like to call this on the show. I know you're relatively new to the show, Steve. We like to call these types of earnings resounding mess, in that they're not really a heck of a lot. This thing is pretty much almost unched on the day, up about 8 cents. After all that Sturm and Drang and the straddle eroding, that 16 handle straddle. You were mentioning it was at 40 cents at the time of your blog. It's down to about 35 or so now. So it continues to erode throughout the day as this resounding meh. You know, we've said it before, listeners, earnings kind of like a balloon. It fills up with all that good volatility juice. And then if their earnings kind of don't do much, or if the event is not a bit of a surprise, that balloon tends to pop and tends to do so fairly aggressively. And we're seeing some of that happening right now in Bank of America. Let's move on, Mr. Rock Lobster. In addition to hitting the old fairway today, what caught your eye in today's activity?
What caught my eye is initially the move up for VIX, and then it just all kind of slowly, you had a little bit of weekend effect, and then kind of petered down to even. But you had a day, I think, almost for a while where you had the market down. And I think VIX in real terms was actually down, vol. I'm looking at some iron condors or an iron condor, and I have that one. I have them up about another 20% for the size that I'm seeing. So the credit jumped pretty well in there. So vol came in around VIX, even though VIX is actually hovering up. The iron condor I have actually was short. So you've got kind of this is basically what the vol picture looks like now. You're going to have a vol market before the election, and you're going to have a vol market after the election. It looks like they're starting to increase some of the volatility prior to the election. And now I'm just looking at the term structure. There's basically November vol after the election is higher than everything else. And I think you could get away with probably selling the bejesus out of everything forward to the election. We'll get a little bit of, maybe we get a little up and down, but I don't see a ton. I don't see a ton that way, but you think about it, we just had an on-farm payroll number, realized vol in the SPY, 10-day realized vol is 8.25%, and VIX is 16. So you know that it's not whatever is moving right now that's driving vol. It is the event, which I think is going to put the hurt on a lot of let's just say the weekly vol. We call them dailies now in the SPX at Option Pit because we think the dailies are coming very quickly. Within a year, because they've already listing three expirations per week. So we're very close at this point. So your guy, like I said, it's going to be a tale of two vol markets. You're going to have the pre-election vol, and you're going to have the post-election vol. I would say, at least given what we have, it's priced already expensively. And even I think the volatility we have prior to the election, it feels a little high to me. But again, like I said, it looks like some of the trade ideas and trades we have on at Option Pit, that sort of short-term vol dropped down a little bit today. So you have down market, down vol, which I think is the biggest. The SPX was down 0.3%, and I think VIX in real terms fell because of the weekend, because it was only up 9 cents. So that's there's, like you said, it's a resounding meh. The market's not doing much. We had decent earnings out of the banks, and there is no giddy up. Since the QE giddy up seems to be dead, we need reasons to rally, and I think that was the one of two sus points earlier this year. That's why he needs higher highs to get excited about really being more aggressively long is I think ultimately you need a reason to go up. You need confidence, you need investor enthusiasm, you need something. And right now it does not appear to be there. What we have is sort of the coasting to nowhere, at least I think for this week. You've got earnings coming out. Netflix just killed it. I think I messed up one of our topics here, but for the most part, I think that's what we have. I think that's how the vol will play out. I think VIX will be a tough product to trade. I don't think it's going to do very much between now and the election. I know that is a very broad call, but it's just the way that the product is structured. If the vol doesn't move, that's expiring in 30 days. VIX is not going to do very much. But you're going to there will be some movement near term in sort of the weekly expirations for just SPY and SPX and things like that. So you're going to have to be careful. You think, the market's not doing anything, VIX is going to go down. It's not looking at that. And if you buy very short-term products in the VIX, you have to be careful because it's hanging on the volatility from farther on. So I'm getting a little far afield of our normal show. I'm getting a little too VIXy, but that's essentially what I've been looking at, and all I'm looking at to see that earnings are actually okay so far, but the market isn't really responding with much of a yeehaw, so to speak.
Well, there is one yeehaw going right now. You kind of you prefaced it, so let's get to it then. You're jumping ahead of us, sir, but he's not like you've ever done the show before or anything like that. It's of course Netflix, the Widowmaker coming in hot and heavy after the bell here. They were pricing in, according to our friends over there at Trade Alert, about a 10% move out there in their straddle, which actually, if you look compared to recent quarters, is somewhat light. They dropped about 13% back in April and 13% again back in July. So 2 consecutive 13% declines. Still, the market only pricing in about a 10% move right now. And as of right now, they were way off, almost 2x, about 19% to the upside. This thing is moving to close. Where did it close? Just shy of 100, 99.80 or so, and trading in the after hours looks like about 118 and a half. Let me refresh and see if it's gapped up even since about 119 now, so about a little over 19%. So the Widowmaker maybe perhaps restoring husbands to the marketplace now, unless you were aggressive premium sellers out there, in which case the widows will be made yet again. I don't know, Steve, Netflix always tends to be a popular one amongst all of the brokers we talk to. It seems to be leading the volume. It probably works for you guys as well. What were you seeing of anything out there in Netflix today? Also, we got good old Beamer coming out after the fact, kind of flipping the script out there. Beamer was pricing in about a 650 move, or about 4%, and as of right now, they're off about $2.40, or right about 1.5%. So, bit of a resounding mess so far for Beamer, but Netflix off to the races, trying to erase the last few quarters. Anything catching your eye there, Steve?
Yeah, absolutely. Netflix. The Widowmaker. Anytime there's a widow, there's usually a big payout potentially if there's any kind of estate. And Netflix did it right for the bulls today. I mean, almost a 20% move. That's huge. And what we see in the options house community is people, they know that vol is going to come in. They want to take some exposure on the earnings. They either are a believer in the Netflix model or they're a seller in the Netflix model, but a lot of people using call spreads, debit call spreads if they're bullish, to try to offset some of that volatility that they're going to be buying. They can't just outright afford or buy that premium. But a lot of people, what they do is they tend to buy close to the money strike options and then sell something out of the money to try to recoup about 35 to 50% of the premium. So what people were looking at actually was buying the 100 calls at $5.50, something like that, because the straddle was priced around $10. And then selling something for anywhere between $2 and $2.50, which actually got them, up near the 108, 110 10-strike call, and they had a nice little trade there. They didn't hit a home run. They didn't buy them outright, which now they might be kicking themselves. But anytime you kick yourselves over doubles win ball games in October.
Yeah, you go mad that way, right? You're thinking that way, like, oh, why didn't I just buy it outright? How many times did buying those things outright get you crushed in Netflix?
More times than you can remember.
Yeah.
And you know what's really sad is IBM, Beamer, Big Blue. Its earnings date used to be what drove the entire CBOE, the Chicago Board of Options.
Were you out on the IBM pit in the CBO?
I was a runner back then,
okay.
I was in the midst of the panic.
Yeah, I started out as a clerk in IBM as well, back when it was the pit. You're right, it was the place to be.
The pit, and I remember the day they ran out of trading cards on the floor. There was not a trading card left on the floor for the day of IBM earnings. That was the day you circled on your calendar. And now IBM's become meh.
Yeah, as a resounding. You're getting on the hang of it.
I'm getting the hang of it.
It's like you've been on the show before, Steve. I like it. But yeah, IBM. In the days of pre-multiple listing, when it was just the Leviathan in the space, consumer and the enterprise, and certainly from an options perspective. And now, yeah, you're right. Usurped by an online movie and TV streaming company of all things, as well as many other things in the public's mind share. Which who'd have thunk it? 15 or 20 years ago. But c'est la vie, that's the world we're in. Speaking of the world we're in, let's jump across now. He's chomping at the bit as well to that little provincial sleepy hamlet of St. Charles. Uncle Mike, a lot of things lighting it up today. IBM, Netflix, VIX, everything else. What was catching your eye today, sir?
Well, in addition to what's already been said, a couple things that I noticed. Overall, in the market itself during the trading hours of today, not including what's happened after market, but during the trading hours of the day, a couple things that kind of caught my eye a little bit. TLT, we actually had a little bit of an uptick in bonds today. I thought the uptick was a little bit more than what was justified based on how little the market went down. It's up 84 cents, and like I said, it's not a huge amount, but it is something to keep an eye on. Bonds have pulled back recently, so I think we still need to keep an eye on that, especially with the reaction to bonds, or especially with the reaction based upon the good earnings that a lot of the financials had on Friday. What I thought was interesting on Friday morning before the market was that there was good earnings by a good amount of the financial firms. We had a nice up day, and then it kind of, or I should say, a nice up morning, and then the market kind of sold off going into the close. So with that, that was one thing that I was looking at today. A little bit of movement in gold, nothing to write home about. The only other interesting thing of note that I saw would be of crude oil. We are below 50 again. So I remember a couple of years ago, we had the magnet number of SPX at 2,000. And it seemed like we were at 2,000 or just maybe a little bit above 2,000 or a little bit below 2,000, seemingly forever. Oil is starting to perhaps go to something along those lines with the 50 mark. It'll be interesting to see if we can get an uptick in oil, but I'm kind of in Andrew's camp right now, and that I think we're going to be coasting for a while until the election is done and to see how the world reacts to it. I think at this stage, most people are predicting Clinton to win, but you never know. So at this stage, I think we're in a coasting phase, and we'll see where we coast on to.
Speaking of electoral bumps, Steve, I was looking over your blog earlier. You had you pulled up some interesting the volatility term structure across the board of the VIX products and others. But of course, you guys have a cool little trade name for it. What'd you call it? Oh yes, the implied volatility constellation. I kind of like that. I like what it implies. It implies the universe of implied volatility. So really quickly walk our listeners through what that is, where they can find it, and what the heck it actually means.
Yeah, right embedded in our option chain on the Options House platform, we think the term structure of volatility, what implied volatility each month has, is really telling information and really required for the active options trader. And so we have this tool, this feature in the option chain called the implied volatility constellation. Very universal, like you said, galaxy. And it really shows each month, each expiration date, what the around the money implied volatility is currently and what it was, what the 30-day average has been. And the interesting thing is, everybody thinks the election, the result is pretty well known as one of the candidates keeps trying to self-destruct. But surprisingly, maybe, I was a little bit surprised. There's actually a relatively significant bump. If you look at the broad-based index, the SPY or the SPX, a little bit of a bump on the expiration immediately following the election. Now, granted, the election hasn't happened yet. You never know. But a lot of people, a lot of traders think the result is known, and Wall Street's digested that. But the options are telling you something different. There's a little bit of an increase in implied volatility in the at-the-money options, basically across the board because people are a little bit nervous, but specifically on that first expiry post-election. So we'll see. Maybe it's going to be an exciting Tuesday.
Yeah, maybe they're expecting another 2000-era election where we have no idea who the president is after Election Day, and it's this crazy back and forth for a month. That would certainly be something. But yeah, that is interesting. You'd expect that all that event risk to be priced into the actual event, not to be lagging somewhat. That's kind of interesting and
But this tool, I tell you, this tool really can highlight that for you, not only for this macro event, the election, but obviously for earnings. Whenever you pull up this tool, it's obvious the options market is not wrong. They know when the potential event is. For biotech companies, if they have any kind of event coming up, the options will tell you that, and it's an important tool to look at prior to entering into your normal routine or your normal trade to know what the options market is saying.
Check out that term structure of volatility. Oh, I'm sorry, the constellation. I like that. I'm going to appropriate that for some of my future shows, Steve. So I'm just giving you warning now ahead of time. I like that.
Let's get some T-shirts made.
I like that. Constellation, the implied volatility constellation. Of course, we got to keep rolling those. Time for us to keep on rolling into perhaps the less shiny, less bright part of the show. Not the constellation, but the dark alley, because it's time for the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody. Welcome to the Odd Block, the portion of the show where Andrew and I and anyone else who's feeling sprightly can put on their trench coats and their get their magnifying glasses and proceed down the dark alley with us to see all the interesting and weird and head scratching and downright shady options activity that's lighting it up today. We're going to kick things off. We were talking Bank of America earlier. Obviously, Deutsche Bank has been on the radar a lot. The financial sector in general is kind of just on the radar now with earnings coming up as well. So an interesting time to be checking in on the old Spider KBW Bank ETF, ticker symbol KBE. This name closing $33.21, off about 17 cents or so, about 0.5% or so on the day. It's the thing that does about 2,300 contracts a day, doing a whopping 11,000 today. Get ready for this: 381 to 1 calls over puts. That's not the highest we've seen, but that's certainly the highest in a little while. That should help you see, listeners, exactly what the heck caught our eye. If you want to find the activity for yourself, you got to scroll out a little bit, all the way down to March of 2017, where you find the March 34 calls going up, starting off with about just a little bit under 6,000 going up. Looks like paper buy-in for about $1.50. That went up in one block over there on the Philly. We also saw another chunk going up about nearly 4,000 for $1.45, right, almost commensurate with that. And then a little bit more sprinkling in on the top, bringing the total to a little over 11,000, I should say. So of today's activity, which was 11,084 total contracts, 11,015 coming in this one sizable trade. Didn't see any stock going up here on this, so no other legs to speak of, and there's only 3 contracts open on this strike, so clearly opening paper here. So this appears to be what it looks like on the surface, which is someone really loving themselves a little bit of KBE. Looking back here on the past year for KBE, it's kind of been an interesting year. It's kind of followed some of the broad markets, you might imagine, hitting some lofty heights towards the end of last year. Then in that tumultuous Jan-Feb period, really taking it on the chin, dropping down to about 26 handle or so before rallying throughout the rest of the year. Having some peaks and troughs, obviously, but making its way back up to where it is now, actually hitting a little higher, about 34.5. Our friend here clearly thinking that it's going to go back on the trajectory of last December and beyond when it was trading 36.5, nearly 37, and certainly beyond. He would need a nice little move into at least that range for these things to really pay off in the long run. So it looks like we got some love here for KBE. Mr. Rock Lobster, what are your thoughts here on our friend? Not really swinging for a home run, but an aggressive swing at the bat here for KBE.
I think it's a fair cut. I think they want some calls, and they're trying to get past the election. They're trying to get past December, and they want to get long. I think they just want to get long banks, unless they've got something against it, which we don't know about, which is certainly always possible, but. Normally, you see call buyers like that because they think something's going up. So the stock moves enough to just warrant a call purchase like this, or I should say the ETF. So it doesn't look too bad to me. But they're looking for, I would say they're looking for prices kind of right. I should say they're looking for 52-week highs and above. And I would say at least at this point they need some help because even with some decent bank earnings, we're not seeing what I would say is the follow through from that. So maybe they're trying to scoop a little pullback today. It's really small and setting up for moves that shall be named at another time.
Yeah, and I would just hop on and sort of echo that and say maybe they see this is obviously not an earnings play. They're out in March, but maybe they see the interest rate environment changing. A lot of people expect something in December. Maybe they think there'll be boom, boom, December and first part of next year, and higher interest rates help this sector, help this ETF more than likely. And maybe that's what they're playing for, a little longer term continuing higher interest rate theme.
They're betting on Yellen and company going crazy between Dece and March. I could certainly see that. We've seen crazier trades here on the show, certainly. And I think everyone's kind of expecting Yellen and company to sit on their hands through the election. But after that, December, all bets are off. We'll see what they have cooking up. And our friend here, perhaps one of Miss Yellen's Fed governors loading up for the future. Wouldn't that be interesting?
Wouldn't that be something?
That would certainly be something. Instead, let's move on to another area where we were looking. Since we're talking financials, good old Bank of America, ticker symbol BAC. We mentioned earlier, Steve, you had it on your blog, kind of the resounding meh. That was their earnings today. Well, we also saw a big print come in there today. Before we even get to that, this is the name that does a pretty decent paper, about 303,000 contracts a day. So one of the more sizable odd block candidates in quite some time, doing about 372,000 or so, about 3-to-1 calls over puts today, which is surprising given that directional bias, kind of given the kind of relatively unched nature of the underlying today, given these earnings. Our friend here today certainly had something to do with that call number, even though he certainly wasn't all of it. What caught our eyes today, listeners, was out there in Dece. It was the Dece 17 calls, not the weeklies, but the regular old Dece, lighting it up, starting with about 15,700 of the D17s going up. Looks like paper buying for 28 cents, doing that in one block over there on the Amex as the day went on. A total of about nearly 20,000 have gone up on that strike. It's worth noting this is all on sizable open interest. There's a lot of open interest out there in Ds. The D16s have a ton, about 203,000. But number 2 out there are the D17s with about 47,000 contracts. So this could be closing, or this could be indeed kind of alluding to what you were saying earlier there, Steve. This could be someone of a similar mindset, expecting even more aggressive, more near-term rate action, and expecting that to benefit Bank of America in the near term, loading up here. Clearly it's post-earnings, so it's not that, or it could be indeed closing on some of this size open interest as well. Mr. Rock Lobster, I know this one kind of came on your radar this morning. Which way are you leaning? You leaning Yellen swing at the bat, or are you leaning closing after a resounding meh?
You know, I had a hard time with that one. What I thought there could be some stock against it. It didn't go up marked with stock, but I think in the notes I wrote a potential for bank. I think it's a little of everything. If it in fact, you know, when you see stock go up in a big block 1 minute after the option print, and it just so happens to be the exact delta that the options are, you know, you think, well, you know, it could be tied to that. So I think it's a combination of all. Either we have some interest rate space and the financials actually have some earning power again, which makes them probably pretty cheap right now, or they just keep, you know, bumping along. So either way, I believe they're looking for some kind of action. So I don't think it's a close. I mean, it is after earnings. It certainly, the timing's right. You know, you can't, if you sold options and bought stock and Bank of America moved 3 cents, you can't get a much better outcome than that to unwind a position. So, you know, could be. That's the one thing. I'll check the open interest tomorrow and see if they're accumulating some volume there. So it's a head scratcher. Let's just go with a head scratcher right now.
Steve, are you feeling your Yellen rates love on this, or are you going more on Andrew's closing theory? What are you feeling on this one?
Yeah, I think Bank of America is definitely, it attracts a lot of interest from a lot of different participants in the marketplace. Institutions are obviously involved. Size like this, definitely institution. This isn't my retail clientele, but Bank of America definitely.
Speak for yourself, sir. My grandmother in Iowa slings 10,000 lots at a clip.
But my, you know, our retail investors, they're involved in this name, right? It's a low price stock, relatively low volatility, sort of, you know, one of the leaders of the banking space, obviously. But you know, this option is relatively inexpensive. You know, you get a 29-30 delta call option on Bank of America. These bank earnings have been good, but no names really busted out to the upside. So normally we don't really encourage folks to buy out of the money options, but as a spec and as a big institution or something like that that could fling this size, you and your grandmother, you know, this option will absolutely explode if there ever is that follow through that a lot of people have been waiting for in these financial names. You know, the 30 delta option it has a relatively high gamma. It's out in December. You know, there's this option will definitely keep you coming in and watching the market every day, and you know, hoping for like a little half-point move in Bank of America. All of a sudden, this thing becomes a real option. So it's, you know, it's sort of a cheap bet to the upside from now till the end of the year.
Speaking of cheap bets, or maybe not so cheap bets in this name, we're getting to our final victim here. This is getting out of the banking sector, getting into 3D Systems Inc., ticker symbol appropriately enough, DDD. So 3Ds, we like that. So this is closing today, 14 and a quarter, pretty much unched on the day. This is the name that does about 10,000 contracts and some change, doing a whopping 36, nearly 37,000 today. 4-1 calls over puts, and a lion's share of that coming on an interesting strike, a fairly deep in the money strike at this point. It was the expiring the 21st, so the OC 13 calls going up. Paper seems like just gobbling them up for prices between $1.19, chasing them all the way up to $1.53, doing a little over 13,000 total on the day, all of that on open interest, yet again, of just 3 contracts. That's the magic open interest number today. Went up on all the floors, pretty much on scattered volume, so they were chasing it wherever they could get it. This is, but of course, some of it was a couple big chunks, but also some small paper, which usually when you see something like that, a big chunk followed by a lot of smaller lots, that does tend to be the hallmark of a newsletter trade. If that's the case, this is a pretty sizable newsletter, moving about 13,000 contracts. Also, a lot of this was also lifting the offer, also perhaps a side of a newsletter trade, that sometimes their execution on the followers, the lemmings, if you will, isn't always the best. But yeah, interesting trade. This is a name that has been kind of vacillating around quite a bit. Back in the nadir of the year in Jan-Feb, it hit about half of where it is now, down to about 650, actually less than half of where it is now, about 14 and a quarter today, before rallying all the way back up to 18.5. And then doing that again recently. So this thing has been on a tier, about $4 higher than where it was right now, then dropping back down after more than doubling, actually tripling. So this thing's been all over the place this year, and it sounds like someone is putting their money where their mouth is, that this rally is going to continue. Not seeing any stock or anything else with this one. Mr. Rocklop should take us home here. This is a funky one, in the money size newsletter call trade. This has weird written all over it.
It does. I actually asked some of my clients that I go, did Schaefer put anything out on? And apparently he was saying 13.5. So somebody instead of buying 13.5 bought 13s. I think. We think again. That's not totally. That is not confirmed, but I think it is definitely a newsletter trade. So I find that very interesting.
And perhaps even odd, considering it is the odd block. But yeah, that's just of all the strikes to choose, it's certainly a meaty one. I don't know if that would be my first choice, but that's an interesting way if you want to get yourself some deltas in a hurry out here in good old triple D's. That is certainly a way you could go after that. I can see your ears perking up on this one, Steve. A bit of a funky one. What are your thoughts here on size, near-term, in-the-money calls in triple D?
Yeah, the near-term part is befuddling, but choosing an in-the-money call option as a proxy for stock, obviously they expect something to happen this week. The 13s trade in a big size you mentioned, but then also those 13.5s did as well trade. Those things, by being so deep in the money, only have about 20 cents of extrinsic value. So they don't need a huge move to be profitable, but they just need it right away.
Yeah, that's kind of what I'm more. I mean, the strike is interesting, but yeah, I'm kind of more wrapping my head around the really, really near term of this, because you're right, this thing's got to hit a home run. It's got to do it soon. It's nice from an extrinsic value perspective. You're saving money there. From a total outlay perspective, though, it isn't the cheapest option. Certainly you can go, nor the cheapest way with a spread or something else to maybe somehow mitigate some of that outlay. You're paying, about 10% of the price of this stock at this point. I know some people out there who have issues with just trading options on stocks this cheap in general. So there's a lot of things that could compound this trade and make it a wee bit weird, a little bit befuddling, perhaps, dare I say, a wee bit odd. But it is Monday. You guys are chomping at the bit, I know, as well. So without further ado, let's keep on rolling right on into the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the mail block.
All right, everybody, welcome to the mail block. This is indeed the portion of the show where you guys take the reins every Monday with your questions, crazy, awesome, interesting, and otherwise. You guys have been doing awesome business here. So let's see how many we can get to here. You guys go hit us up via the app, via the website, via email, questions at theoptionsinsider.com. If you are streaming live now, hit us up via Mixlr as well, MIXLR, or via Twitter or StockTwits. You'll notice Twitter and StockTwits, the same thing these days. We merged the two, so we've always been at options on Twitter, now also at options on StockTwits. Make it easier for you guys to find us. We're options pretty much everywhere. Everywhere you're looking for options, that's us. All right, so moving on to see how many we can get to today. Let's start off with, this is actually an interesting one. This one came in from Adam. A bit of a semantics question, but an interesting one nonetheless. He writes, could you please explain what it means to, quote, gamma scalp? and why this is not called delta scalping. Thanks, and your show has saved me a lot of money now that I've come to the dark side. I don't know if that means come to the dark side of options or he's come to the dark side of premium selling. Either way, he's doing good. So congratulations. Welcome to the show, Adam. A good question. We talk about gamma scalping a lot. I think I mentioned this just recently on our most recent volatility views, which will be coming out as you listen to this show, listeners. And of course, it's the old trick that a lot of us used to do. I'm sure Steve used to do it when you were on the floor of the SIBO. It was kind of our way to defend long premium positions, which are eroding. But the plus side of that is that you got a lot of gamma, which was nice. And so the underlying, when it moved, of course, gamma being your rate of change of delta, the underlying would rally. You'd get long a bunch of shares. You could then sell them. And then hopefully you had worked out a bunch of different ways. And I had a million different ways I would do this. Steve, I'm sure you did too, and Andrew as well. You'd work your whatever it could be, Fibonacci's, support and resistance, whatever it could, trying to find your optimum way to gamma scalp. And then hopefully, if you worked out, you would catch the exact peak of the intraday for the stock, and then you let it retrace back down to where it opened, or maybe even below if you're being a little bit aggressive, and buy those shares back. And that back and forth scalping of the underlying is where you made some days the lion's share of your money, or at least offset a lot of your decay for that day. But he has an interesting point here that even though it is the gamma that is causing the delta to change, you are technically selling the deltas, I guess. So he has a bit of an interesting semantic point. Maybe we'll start with you, Uncle Mike, because I know you're probably intrigued by this one as well. What are your thoughts here on his notion, gamma versus delta scalping, and why we choose one over the other?
Well, I mean, it's not something that I really do a lot of, so I can't really comment too much on it. But I mean, if you do have long premium, you do have to do some type of scalping if you're a consistent long premium person. So there's no doubt about that. Or just simply have risk management and that you just don't do it too often, or have enough money in cash, whatever the case may be. So with that, I don't know if I would necessarily call myself a scalper, so to speak. But with that being said, I think if you are going to be long premium, doing gamma scalping versus delta scalping, if you have, let's say that you do just buy an at-the-money put, and you believe you're bearish and you buy an at-the-money put, meaning you're buying all premium. Well, what's going to benefit you is that as the market goes your way, as the market is to go lower, then you're going to gain more deltas. And so that can be exciting, so to speak, and the rate at which you gain those deltas is at gamma. So as the market goes your way, it's kind of like a snowball effect in that the gamma enhances your delta position. So I always tell people it's like shorting more shares without taking on any more out-of-pocket risk as the market's going your way, and it continues to go your way, and it keeps getting better as it goes your way even more. That's a very exciting thing. And so with that, you have to have an understanding of when you get out, because if you stay in too long, it can go against you, and then the time decay is going to neutralize that exciting feeling of the gammas building up in your favor, or the gamma building up the delta in your favor. But with that, I would say that's probably the way with which to gamma scalp. I would typically want to do more of those things either in a lower volatility environment or in a higher volatility environment with which I expect the volatility to stay higher for a long enough period of time for me to get out and avoid the theta monster, so to speak.
Or the flying spaghetti monster, whichever comes first.
Oh, I hate that flying spaghetti.
Steve, I know you used to do a lot of gamma scalping over there on the SIBO. We all did. It was kind of the price of doing business down there. What are your thoughts here for Adam and his interesting semantics question?
Yeah, Adam, I like this question a lot. In fact, I think there's a lot of misconceptions especially among retail investors, that I think I might write a strategy piece on this exact question.
There you go, stealing from our listeners. Steal from the best.
Don't you think? Anyway, a lot of people think you're gamma scalping if you buy an option, but until you actually hedge that option, a professional market maker, a professional options trader, they never took really a delta bet unless it was a conscious delta bet. And that's a delta scalp. If you buy a put, you are delta scalping. You have negative deltas. You're expecting the market to go down. If you're right, you can take those deltas off by either selling the put or buying some stock. But that gamma piece that you talked about and that Uncle Mike talked about, that's the additional piece that you get. And you really aren't gamma scalping until you hedge away that first derivative or the delta. The delta has a much bigger impact initially. And so a professional market maker, a professional options trader would hedge that delta exposure of that at the money option, right? 50 delta, you take that off. And then the change in that delta, that would be the additional bonus you had. So if you're long options, you want movement. Either way, you buy a put and you hedge that initial delta, you don't care if the market goes up or down. You just need it to move. And then once it moves, your additional deltas or your reduced deltas, and now you have too big of a hedge on, you get to take that off. When you're long options and the market moves, you get to sell deltas higher to get flat again, or buy deltas, buy shares lower at lower prices to flatten yourself again. And that is the true gamma. But this is a much bigger topic probably than just one mail block question.
Yeah, probably. In fact, we're running up against. I want to make sure we get at least one more. Well, I love it. They get us going on these crazy topics, Steve, and we fill up the whole segment with it. But it's good. It's good.
Give me some future future content.
Steve's stealing content for you. Make sure you get your invoice out to them for content forthwith. We got one more here. We got time for at least one more. We got a bunch more charts and everything. We don't have time to get to those. This one comes from Ian Wagner. He says, why trade, another kind of semantic / thought question, why trade volatility versus direction or income? Your preference, is it a more favorable risk-reward profile? This is an interesting one. Mr. Rocklaps, I know you haven't had a chance to chime in, so we're running up against, I'll give you a chance to chime in. I know this is right up your alley. But this is a topic we talk about a lot, obviously, here on the show. We always really talk about our volatility levels and trading volatility. We do talk about yield and those kind of things in the odd block a lot, and those are interesting things. But we don't do a lot of the direction, which is kind of what Steve was alluding to before, the delta type trading. This kind of, I think it's not really in our blood. As old school market makers, we tend not to roll that way. But that said, Mr. Rocklobster, what do you have to say here for our friend, Mr. Ian Wagner?
Well, I think the biggest one is, number one is volatility, either directly or indirectly, plays a part in direction and income of an option strategy, number one. Besides, and also when you talk about trading volatility, you're trading direct vol, what I'll call like gamma-less vol, where you just trade VIX or VXX or UVXY or a vol product, where you're doing the direction of volatility, or you're using the change in volatility of the options, which we call, change in the more physical indexes like SPX or NDX or something like that. But the biggest reason is because it reverts. Volatility can't go to zero. It can't go to 1,000 and stay there. It might for a day, but it has a hard time staying there. So the reason why is the tunnel for volatility as far as a direction goes is much smaller and bouncier than for a lot of equities. So since that the motion of volatility has a different characteristic than, let's say, where is Apple going or where is CMG going, right? CMG was an $800 stock and it's now $390. That is a long way down. So it is the nature of the type of moves that's better. So as option traders, at least I learned, tape reading pattern and essentially just vol in following a volatility direction, but also being able to manage a vol position. So you can add more short vol as long as you can control the gamma and as long as you have enough capital. It's very hard to manage a delta that keeps going away from you and keeps going away from you and just never ends. So those are different types of trade. So if you sell 30 volatility, again, I'm speaking in generalities, it can come in. You could sell Amazon at 700 and it goes to 725, 50, 800, 850, and it never comes back. Okay, it's just volatility has a different way to trade. Of course, all of our education and Option Pit is founded on vol trading. I think everybody else does the kind of technical directional stuff. So that's not what we do. We kind of teach people how to look at the market like a liquidity or market maker would think about it, and what are the kind of vol trades that work given your circumstances. So I think the big reason is the nature of how things move and how you can position and actually trade volatility versus the other stuff, versus direction. Income to me in a vol trade, to me, they're the same, even though you don't think they are. How you position the volatility is really going to determine whether your income trade really makes any money or not, mostly. So there you go. That's it in a nutshell for me.
Speaking of that's it for that segment. We got to keep on rolling. I love your questions. Keep them coming. We'll get to as many as we can on future shows. But now it's time for us to keep on rolling to our final segment. It's time for Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, everybody, Around the Block, of course, a portion of the show where we tell you what we're watching for the rest of this week, at least until we gather here together again on Thursday. Quick check-in on those names we were looking at the top of the show. They're reporting after the bell. We said IBM, a bit of a resounding meh, looking a little bit more aggressive now. They were pricing at about a 4% move, down now about a little over 3% or nearly 5 handles. So that one selling off as the show has progressed. And looks like Netflix has pretty much, if this quote is not stale, yeah, it's good, has pretty much stabilized around that 19 handle, up about 19 points or a little over 19%, nearly double what they were pricing in. So that's what happens when you sleep on the Widowmaker after a couple of interesting quarters and you underprice their vol. It blows through it. It has been known to do that. And it looks like if it closes here, or opens here tomorrow, I should say, it's going to be another aggressive week. Speaking of crazy weeks, we got a lot of names on the horizon. All of you guys have been writing in saying, I want some earnings action. Here you go. It's coming, and it's coming in spades. Tomorrow we got Domino's, if you're into the pizza, Goldman Sachs, Intel, my old stomping grounds, J&J. We got Mattel for all you, and eBay, all you toy lovers out there on Wednesday. American Airlines, good old Softy on Thursday. I usually see Intel and Microsoft usually were a lot closer, like back-to-back. Now they're moving and splitting up a little bit. Verizon also on Thursday. Friday, GE. A ton of names. I know, Steve, you pretty much listed them all on your blog over there this week. What's catching your eye? What are you watching for the rest of this week?
Yeah, I listed the ones that our folks really kind of focus on. And the thing that's good about this week is the earnings are across multiple sectors. Industrials, we got GE, which is an industrial company now. No longer, they got rid of their financial arm, so they're actually an industrial company. Honeywell. On the industrial space, we have some more technology names in Intel and Microsoft, as you mentioned. Johnny John, McDonald's, as well as Domino's. So we'll see what the individual fast food companies are doing. So I like that there's a little bit of something for everybody. We got a smorgasbord, if you will.
It's an earnings buffet this week, like a Vegas buffet. $5, all you can eat, tech stocks, some financials, and all of the above. Uncle Mike, what's catching your rest of this week, sir?
Yeah, for some reason I feel hungry now with these buffets and smorgasbords. We're past last week's snack bar. Now it's all you can eat, by gosh. Watching the earnings just like everyone else is. Also, as we said earlier, watching oil, want to see what the $50 mark holds to see if we can go through it again or we just continue to hold back on it. So I would say earnings are the big thing. Of course, we have the debate coming up this week as well. Don't know if that's going to be that much of a market mover, but as I always say, let's have faith in our politicians. Either side of the aisle, they can sure screw it up if they want to.
I was going to say you have more faith than I do, but then you ended it the right way, so I'm with you. I'm with you on that one. All right, and last but not least, our token Maine libertarian, Mr. Rock Lobster. What are you watching for the rest of this week, sir?
Give me liberty or give me death. Oh, whoops, sorry, wrong radio
state.
show.
Wrong state, sir.
This week, more earnings. Let's see if we can get any earnings momentum, and whether the end of QE is basically the end of this rally. The rally we had from, I think, SPX 660 something, 66 I think might have been the low tick for SPX in 2009. So we have had a heck of a rally from there. An okay rally from the old highs in 2007. What was the high? 1800 then or something like that. 1600 were the old highs in 2007. So yes, we've had some rally. What takes us to the next? What takes the market higher? I think we need earnings. We need huge, big, and fat earnings growth at this point. You know, the politicians can argue how to create that. That's their job. We'll let them do that. But ultimately, if we want higher stock prices, we need a reason to go there. And we have not been able to get to new highs, I think, for precisely that reason. We have had okay earnings, but not fantastic growing earnings, except in select names. So I'm looking for earnings, and I'm also looking to see how the term structure, I'm going to rename it the Vol Constellation.
Uh-oh, we're all borrowing that. It's a lot of borrowing going on. We're borrowing from Steve.
Catchy,
Steve's borrowing from our listeners. Everyone's borrowing, to use the term. We won't say thieving here or stealing, we're just borrowing.
Oh, yeah, well, you borrow. It's catchy, though. It's catchy.
Homage, if you will.
So we'll see, again, looking at that term structure and how high can VIX go without the market moving and everybody worried about something happening. Normally, to me, that's usually right around 16 to 18% VIX without actual having a driver, meaning unless we have a couple of down 2% days. It's a different story. Then VIX goes over 20 easily. But for now, we don't have close to that. So the earnings are just good enough to keep the market from kind of getting sick, but they're not good enough to make the market go, go, go. And that's kind of what we're looking for.
All right, everybody. That rockin' tunes mean we've come to the close of yet another amazing segue journey voyage into all things option block. Started off talking about all things earnings, Bank of America, Beamer, the Widowmaker. Got into some funky activity out there, as we always do, in the odd block before getting into a bunch of your questions. The crazier, the better. We love all those crazy questions. And then wrapping up with a glimpse into the future. An interesting week in store, so if you're an active trader, I'm sure you are if you're listening to this show, then you got a lot to sink your teeth into. But one last time before you go, let me check in with each of my cohorts here, my partners in crime, see what they have cooking up. Steve, we'll start with you. In addition to the implied volatility constellation, which I think it's safe to say we're all borrowing after the show, what else do you guys have cooking up over there at Options House?
So we just posted a last week's webinar onto our archives, and if you ever were questioning whether to do a debit call spread or a credit put spread, or a credit call spread or a debit put spread, take a quick look at that webinar, and I think you might find the analysis insightful. And come to Options House for the constellation.
There you go, optionshouse.com/insider. Check it out and kick the tires for 2 months for free. It's a pretty good deal. I'm going to go do that myself. And before you got to go, Mr. Rock Lobster, what's cooking in the land of all things the pit? This will be the part where you unmute, sir.
I know, because I've never done the show before.
There you go.
Kyle, cut that. I want to see, again, for us, we have our boot camp starting at the end of the month. So if you actually want to understand what that volatility constellation thing is, come on over to Option Pit, and we'll help you get some learning besides whatever they feed you over there at Options House. There we go.
You got to watch out, Steve. These guys, they stole my options boot camp title. They're going to steal your options or implied volatility constellation. They're borrowers over there. A lot of homages in the land of the pit. All right.
Homage.
Yes, homage. All right. Now go forth before you have any umbrage. And Uncle Mike, what's cooking in the land of all things RCM?
Well, if you do have some umbrage with your current financial advisor, feel free to give me a call. I enjoy working with clients. I enjoy working with clients that have the taste for the option product. If you have as little as a couple $100 a month to invest, or as much as a couple $1 billion with which you need help with, or anything in between, feel free to contact me at any time, 312-212-3531, or shoot me an email at mtusaw@rcmfs.com.
There you go, mtusaw@rcmfs.com. Check him out and check out his book over there on Amazon. Go along with him if you are so inclined. The price of a latte or two, and you could have some good edumacation on your hands. And on behalf of myself and Steve and Uncle Mike and the Rock Lobster and indeed myself, I thank all of you out there in the listening audience for downloading and streaming and subscribing. And of course, for sending in such great questions. Keep them coming. You guys are all over the place, which we love. You keep us on our toes. And if you are so inclined, you like what Steve and the team are doing, head on over to optionshouse.com/insider. Pick the tires for 2 months for free. Can't beat that. And we'll see you next time for more of the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.